Celia Hatton there in Beijing. Well, with me now via webcam is Michele Garaci. He's head of the China Economic Policy Programme at Nottingham University Business School in China. Joining us now, though, from Italy, I understand. Thanks very much for sparing some time to speak to us. I know you're on holiday at the moment.
Thanks to you.
I just wanted to ask what your interpretation is of events in China at the moment.
Well, if we look at the performance of the stock market in the last couple of months, it could be called a correction. We just need to look at the graph extended starting from 12 months ago, and we see a sharp, irrational rise starting in the spring of this year, leading up to 5,100 on the Shanghai index. Clearly, that was unsustainable. And the interesting thing was that as more and more bad news were coming out of the Chinese real economy during the second half of 2014 and the first half of 2015, the more bad news came out, the more the market was going up. Clearly, a disconnect, like you just said, between financial markets and the real economy. So what I see now is a reconnect to the real economy, and that brings values down to the level where they belong.
And why was there that disconnect? Why were the stocks going up more than the real economy?
There was, back in September, some very hyped media in China encouraging the average citizen to purchase stocks. At the same time, the government was lowering interest rates, meaning that people's savings in the banks were yielding lower rates. The casino business in Macau was being, in a way, not shut down, but revenue were going down. So the average Chinese investors didn't have many other places where to put the money. Real estate was not doing well, so bank returns were low. Real estate no good. Gambling was no good. The best substitute for the casino in Macau was the stock market, and hence the pouring of money into the stock market. Irrational exuberance, if we can use one of our terms.
What do you think is going to happen now? There has been a great deal of panic, hasn't there, in the press, certainly here, but is that the reaction there in China?
Not so much, because let's not forget, the stock market is always more or less a zero-sum game, so it's a transfer of money. The majority of investors are really small business. When I drive around Shanghai, even if I go buy something small in a small shop, I always see the old man there with a computer screen looking at share prices. Taxi driver always asks me about share prices. It's really a substitute for gambling, and it is a transfer of money. Someone loses, someone wins. Of course, there are going to be big losers now. Some people are going to lose a lot of money, but some people have made a lot of money. So I do not see a major, yet today, I do not see a major impact from the stock market into the real economy, because you see, the relation of causality should actually work the other way around. It is the real economy that should impact the stock markets, not the other way around. Although there are some mechanisms through which clearly a sudden and a sharp and violent decline in the stock market like we're seeing today could actually have some impact also on the real economy, because obviously some company will lose the opportunity to access financing,
yes,
and some who will probably buy something would not have the funds to do that.
I have many more questions. I'm sorry we're out of time, but thanks very much for joining us. Michele Garaci, thank you so much. Well, what is the European market reaction looking like? Alice, tell us.
Well, it's actually all looking a lot calmer today, Geeta. Volatile global markets getting some respite from the latest bloodletting on Tuesday, with bargain hunters nudging up Asian and European stocks.